Okay. Most founders think the challenge is finding an investor. They believe that if they can get the right meeting, tell the right story, and raise the money, the business will finally have the room it needs to just grow. But investors are not just buying into an idea, they are judging the founder's discipline, decision making, the numbers, the market evidence, and ability to handle pressure when someone else's capital is at risk. Funding does not make weak business stronger, it makes weak thinking more visible. Listen to the end, and you'll walk away knowing what investors recognize before a founder is truly investor ready, what warning signs appear before funding becomes dangerous, and also what changes in your decision once an investor is on board. So, welcome to the Mentor Business Podcast, where we explore with entrepreneurs what they learn too late so we can teach you early and save you 10 years of your entrepreneur journey. I'm Dr. Lewis Hayden, multi business owner, investor, and doctor of management. And I'm here today with Geoff Walters, who's a serial investor, entrepreneur himself. And he's going to start to have a discussion with me about what he sees is the future of investing for angel investing, seed investing, all these different types. He'll talk about all the different areas investing so that you can be more clued up and so that you can make better decisions in your business. So welcome to the show, Geoff. How you going?
I'm all right. Nice to be here.
Good to meet you. Tell us about your background then and what got you here.
Okay, so my background's largely in fintech. The thing that most people will recognize is that I was the product manager of the first internet bank account in the UK, which was the Egg Card. Other people that also claim they did the first internet bank account in the UK might disagree, but we think it's the Egg Card. From there, I built and sold 3 of my own companies. I've been in various levels of banking from sort of executive to board level since then. Retired in 2018 into startup investing. We're very early stage investors across the UK. We have something like about 100 investments into tech businesses now. We're very proud of the fact that we are probably, it's a bit of a Carlsberg statement, probably the most inclusive investor in the UK. Yeah, and that's what I do right now.
Good stuff. So just before we get into it then, I mean, the term investor can mean a few different things. What
Sure.
are the sort of investors that are out there and which category do you fit in?
Okay, so we're a very, very early stage investor. We're the first check that somebody receives. And therefore, we probably fit into the category of angel investment. So we are there for businesses that are pre-seed, they largely pre-revenue, they're trying to find product market fit. So angel investors, usually the first check somebody receives, they're believing in the person and the idea and the strategy and that there's a market for it. As you move on into later stages of investment, so seed and then Series A, Series B in equity investment, that's usually institutional money. So it's coming from what people might consider to be venture capital firms. There are other types of money that are available to companies. So a lot of grant funding if you're a science, high intellectual property type of business. Those grants typically coming from institutions like Innovate UK or from universities. And then finally, of course, there is the type of money that supports most businesses in the UK, which is bank debt, right? And that dwarfs venture capital, dwarfs grant money, and is the way most businesses fund their growth.
Okay. So at what stage would you start to come in then? Would you say, what does your journey look like when you're working with a business? Do they approach you or do you approach them?
So we run programs usually with a region. So we've just completed one up in Glasgow. We run one in the West Midlands. That is a program which is focused on bringing growth to that region, bringing jobs to that region, trying to create the businesses that will hire people in the future. So when people come to us, they're usually at the idea stage. They've got a pitch deck and a dream, and we help them create the product. We help them validate that product in the market. We get them to what angel investors would consider to be traction. So they've got £100,000 worth of revenue, which is repeatable, and they've proven that there's a market for what they're selling. That's our job. That's what my organization, which I didn't introduce, called Greater Things, but that's what that does. When I'm investing my own money, when I'm angel investing, usually it's at that stage that somebody has traction, that they are, they've proven that the business idea works. So I do two things, really. We have a program for people that are pre-revenue, proving a product, and then personally, we invest in, I invest in companies that are starting to grow. So two stages.
I think the big question that's out there then, Joff, is what sort of businesses are attractive for investors in 2026?
It's a really good question. So, my fintech background, stable coins are so hot right now. Right? So let's put that to one side. I think one of the areas that's really interested me over the past couple of years is EdTech. Education is changing substantially. And if I look at the businesses that we've backed between 2023 and now, so the past 3 years, it's EdTechs that have done really well. It's an easy market to get into, and it's a big market to grow into.
Educational technology, is that correct?
Yeah. Educational technology, yeah. So really providing education outside of the universities, scalable, easily accessible education. The other thing which is obviously happening right now, particularly in our sweet spot, which is sort of scalable software-based businesses, is the automation of what was highly skilled roles, which are repeatable, using artificial intelligence. So that's in the legal space, actually in financial back office, we're seeing an awful lot of that. Some consultative roles that are moving into artificial intelligence. So for instance, perimeter checks for whether you're going to breach regulation can now be done quite well with artificial intelligence. So it becomes a scalable service. And we're seeing an awful lot of that.
Yeah, you say you see an awful lot of it, though, but which ones do you invest in? Which ones get you most excited as an investor?
I try, so we just to be clear, Greater Things itself, our investments are now underwritten and picked by robots, right? We underwrite them like a bank underwrites debt. Yeah. So I try not to get too personally involved. We let the robots make the bets. But, the things that I'm most excited about personally are now really things that have a big societal impact. I don't consider myself an impact investor, but as you get older, you start to think, well, are we doing a good thing? And so for me, those things which are creating opportunities for the next generation to come through, that are creating growth opportunities and are shifting growth out of London, out of the Golden Triangle into the wider regions.
Nice.
Where we need to create opportunities for the people of the future. That really excites me as well. So, that's why we're in the West Midlands. It's why we've been up in Glasgow. It's why when we're focusing on where to go next, we haven't looked at moving into Oxford, Cambridge or London. We've looked at moving into the northeast, the northwest, southwest.
So for a small business owner then, how do they become investor ready?
The three things that I think really matter, first of all, is your own personal experience. There is, it's really hard for somebody to build a business that focuses on astronauts if they've not come from NASA, right? So you need to be believable as an individual. You need an opinion which is differentiated. You need to be able to back that opinion up with evidence. So the person that is building the business has to have qualified themselves in their subject and also qualified themselves as an entrepreneur. There is that thing of you having tenacity, you having drive, you having those inventive skills that come with building out a business, and you having a risk appetite.
So you're saying that qualifications through university, there's this big thing that you see on social media now, where people say you don't need to go to university, blah, 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 blah. You just need to go out there and start a business, and so who's a celebrity, never went to university. That it's kind of like causing a gap between social media and what's actually saying. But you're saying is that you need that qualification, that skill, but you also need to show your entrepreneurial qualification as well.
Let's be clear about what I mean by qualification, right? So I didn't go to university, just to be clear. Qualification for me is that you have done the work to understand your market, right? So that might mean that if I was, I don't know, creating a hydrogen capture business, I would fully expect that person to have studied that as a PhD, right? So that's one end of the spectrum. And that kind of leans towards deep tech. but it might be that you've just come out of being, I don't know, a product manager of a credit card, and you want to go into running a payments business. You might not have gone to university, but by God, do you know the market, right? So qualification is, I've qualified myself in the market, whether that's through formal education or through experience. What we don't want to see is somebody that's had an idea in a bath last night and thinks that's enough qualification to build a business. And I think for this is a throwaway comment, but there is an awful lot of kind of TikTok generation, if we can call it that, whether they're 50 or 20, that think that you can slam something into AI, press a button, and that will be enough to get you into building a successful business. It's just not true.
Yeah, it's like a lot of naivety, isn't it? That they see what they can do. But remember, all these other businesses are also using AI, and they're investing hundreds of thousands, if not millions, into AI. So that you've got to always remember that when if you think that you've got something new, most likely the researchers and the scientists and the technical people in these other companies are already doing it, and there's probably a reason why it hasn't come to market yet.
Yeah, I mean that sense that, and I mean we're market leading in our use of AI in what we do, but that sense that AI can replace human capital in the success story of an early stage startup is nonsense, right?
Right, interesting.
You know, the things that drive a business at the earliest stages are insight and credibility. So getting out and understanding your customer is a very human job. It's going and sitting down and talking to people and listening to what they have to say. And building credibility is about building partnerships, building customer relationships, and that's still a very human job. AI, when we look across the estate of businesses that have tried to, I don't know, smash a prompt into go high level and win customers by just sending out tens of thousands of messages, aren't doing half as well as those that have gone around the corner and spoken to the business that they want to sell to. And that tells you something about the importance of human capital in this modern AI world. It's actually a differentiator.
I think that's really good as well, mentioning things like go high level. You know, there's a lot of people that think that investors like you and I don't understand that sort of world. And it's like, we do. We see it all the time. We know about HubSpot. We know about the Claude. We know about this technology. We're hearing people come through with it all the time in our pitch events. I mean, that's where I met you, Geoff, wasn't it? It was with the Aston Business School pitch event where we get the MBA students pitch their ideas. And no doubt about it, they've got to do this for a qualification, you know. But some of the ideas that come through, one of the big thing that stood out for me, Geoff, was like, well, great, but how do you make your first sale in the first 90 days?
How are you going to get your first person to give you money? Yeah.
Right.
And it's a massive indicator of success, right? So if you talk about the startup journey, I have recognized that there is a problem in the market, and I'm going to seek to solve that problem. That's the right version. The wrong version is I've built a product and I'm going to try and sell it. That doesn't work. So I've seen there's a problem. I'm going to try and solve the problem. The businesses that we see succeed, the clearest indicator of success is they have gone and got paid to solve that problem by any means, right? So they may have been paid as a consultant. They may have been paid to offer education that solves or helps a business solve that problem. And then they start to automate behind that. They build the product, the service that makes what they've done scalable, right? The businesses that fail inevitably is someone that's vibe coded something in their back bedroom. They come up with a platform. They say, look, a platform. We've made a platform. And then they try and smash out 10,000 cold leads into the market to sell it.
Right.
And the reason that's a less successful strategy, it's about added value. If somebody can do something for free, that has no added value. So you don't really get paid for it. And so if I can build a business with AI in 10 minutes, everybody can build that business with AI in 10 minutes. There's very little added value. Therefore, there's little margin, and there's little hope for success in the future.
It's interesting. It's interesting. I mean, one of the investments that that came through the day when we was doing a Dragon's Den style thing was an AI company. And for me, it was like, this is brilliant, but you're building it the wrong way. You're not looking at the actual problem that the businesses have. I mean, they had found an idea,
Yep.
But in the grand scheme of what that looks like out of the academic world and how it can start to help SMEs, I mean, the majority of businesses now are SMEs, compared to how it was like 50 years ago. So it's having that experience from an investor as well. I think it's not just about the money that you get with an investor. You get the mentoring, you get the wisdom, you get the save 10 years of your life, basically, to say, look, don't do that.
Yeah.
So don't do that, and don't do that with my money.
Yep. It's a huge thing. I mean, if I go and sit in a classic incubator or accelerator right now, I would say that the mix of effort is 90% on writing pitch decks and trying to get money off of people, and 10% on going out and talking to customers and trying to sell something, which is entirely the wrong way around. I guess what a good mentor or a good team around somebody does is say, right, here's where you expend your time and energy. You were never going to get that grant. Don't chase it. Even you're not an investable business, but that's not a bad thing, by the way. If I've got a business that's currently working with us as a two-person business. They're turning over £250,000 a year. So they've both got a great salary, right? It's got a great moat around it. No one's taking that away from them. It's not going to scale into a market that will make it worth 20, 30, 40 million, but there's nothing wrong with it. That's a great business. Carry on doing what you're doing. So a good mentor helps businesses focus down on what's important, what makes them stable, what makes them successful, and if it's relevant, will help to guide them towards the type of capital that makes them scale.
Yeah. So what makes a business, for a small business then, what makes them not investable? What makes them not investor ready? If you was to put into some bullet points, what would you list out?
So what do we say to begin with? Talent is a huge thing. So certainly at the earliest stages, kind of angel stage, people look at the founder really hard. That because there's so much risk around that business that the founder is really important. They need to have the tenacity to survive 2 years with no money, all of those good things, right? They have to have what it takes. Traction, nobody's getting invested unless they've proven that they can sell something and they can sell it repeatedly. That idea that you can go with a really good pitch deck into an investment now, or into, say, an angel group, or or somebody like SFC, an early stage fund, and the pitch deck and the idea is enough to get you the capital, is a nonsense. You have to be able to prove that you can sell this thing over and over again successfully, and that the business model makes sense, you can make money out of it. And then the final thing is that the market is big enough for that to grow to have a material exit, and probably quickly as well, right? So if you cannot sell that business in 5 to 10 years, depending on when you're getting investment, so from an angel within 10 years, from a fund within 5, if you can't exit for 20, 30, 40 million because the market's not big enough, you're never going to get investment. And just to be clear, in the UK, there are about 600 material exits for £20 million or more every year.
Wow.
Right? So that's 0.02% of the UK business population. It's teeny tiny number.
That's incredible. That's a good stats. That is, I didn't know that.
Right. So there's 100,000 startups a year. Maybe 2,000 of them will receive any kind of significant funding round, so SEI, SEIS round. So already that's 2%. And then, in those 600 exits, most of them are generational family businesses that have been around for 30, 40 years, or they're funding instruments. They're not really startups. So maybe 100 startups a year are getting out the back of that gate from a later stage VC fund. So it's not a big, it's a big gamble to get into that tiny, hole in a needle, if you like.
What's interesting, Geoff, is that what do you think Dragon's Den and Shark Tank teach entrepreneurs and business owners in the wrong way?
Yeah.
Do you think they're useful? Is that good? Is that good investment education, or do you think it's wrong, that it's deluding people?
So I think it's innovation theatre, and I think it sends the wrong message. I don't think most businesses are not high growth businesses, and they're not deep tech businesses, and that's where equity investment really lives, right? So it's selling a story that business growth is an equity story, and it really isn't. For most businesses, it's a trade and bank debt story, right? But you can't really make a very exciting program out of, you know, applying for a loan online. So it's a bit of innovation theatre. One of the problems that I have, and I've been vocal about with things like Dragon's Den and Shark Tank, is that actually one of the big problems we have with the equity ladder is inclusion. All of the people that get investment look like me. They're middle-aged, middle-class white men with a decent education. One of the problems is that pitching as a mechanism puts off a lot of female founders, a lot of ethnic minority founders, because, to quote one of the founders that we funded, poor young black girls don't want to beg rich old white men for money, right? Which is a pretty stark phrase, but it kind of gives you that sense of what pitching as a mechanism does. So I think, and don't get me wrong, I make this point about pitching as a mechanism. I don't believe that Dragon's Den itself has problems with equality. They obviously pick the candidates that go on the program well. They pick their investors well. But the mechanism of pitching in the venture capital system is one of the biggest problems we have with inclusion. So I kind of feel, I'm not a TV producer, I have no idea how to do TV, but I sort of feel like Dragon's Den and those programs are past their sell-by date. I'd love to see something that does a kind of, takes a different entertainment paradigm, maybe what's the program where he builds exciting buildings? Grand Designs, right? Something that follows a successful startup through a journey, which shows the real story of the late nights, the sweat, the grit, the determination. Would probably give people a better idea of what it takes to get from A to B. It isn't transactional. You don't turn up and say, here's my idea, and somebody says, here's £1 million. It is a slog, right? And it would be much more interesting to see that story play out.
Yeah. You don't see the due diligence that goes on behind the scenes of everything. You don't know about that person's bad credit. You don't know what they've been through. And
in fact, I will credit Duncan Bannatyne, a man who I accidentally started a conversation with in Piccadilly once because I thought I knew him. I don't know him. It's that thing of bumping into a TV person and thinking, I know this guy. Oh, crap, he's off the TV. Anyway, that's a story for another time. Duncan Bannatyne said something which really inspired me, right? I mean, I've been through that startup journey a few times. It's tough. It's heartbreakingly tough. And he tells this story about buying his first, I think he bought a care home. And he used to drive home from the care home. And obviously the stress of the day, the stress of not having enough money to pay the bills, all of those things. He used to pull into a lay-by, and it was his crying lay-by, right?
Wow.
He used to pull in and have a good sob so the people at work didn't see him and the people at home didn't see how much it was affecting him. And that's a very real story of what it takes to build a business. You know, I think most founders would recognize that maybe they don't have a lay-by for that, but would recognize those moments early in the startup journey. So I think telling that story about how you build a successful business is actually more interesting than him sitting there and waving, 50 grand at somebody and saying, well done, you've done a good pitch, right? Which isn't very real.
I think that's really good as well for you to be authentic about that. But that's the real world, because as investors, you and I need to realize that this might seem like a big dream unicorn right now, and it sounds really good. Yeah, they have got proof of concept. This can go far. But it's about supporting that entrepreneur on their way, that business owner on their way. And you having that insight, like you've just mentioned, is all part of having a great investor.
For sure. I mean, we as I say, we've got about, 100 founders currently that we've got some kind of equity relationship with. One of the things that we've been focused on over the past 6-12 months is building mental health support around that. So working with Dr. David Amore. If you don't have anybody helping you with your mental health, I recommend Dr. David Amore, himself a founder. So he gets both sides of the coin. And he's been assisting some of our founders with, everything from just how to build your mental resilience for the startup journey, and then frankly, for some of our, Series B founders, he's doing proper therapeutic help.
What does Series B mean for the listeners?
Oh, okay. So that's it's you receive your first £250,000 from an angel. Happy days. That's your first investment. When you start really scaling, and you're moving from being a kind of maybe a regional brand or a national brand, and you need to go out on the world stage, you move from sort of startup investment to scale-up investment to growth investment. It's what America does better than the UK. That's the really big checks, so the £20 million checks and beyond. Right. So at that point, you're going to be becoming a group of companies, you're acquiring companies, you've moved from being a startup founder to being a proper CEO with a board governance and all those things. That's where Series B kicks in. So when people think about venture capital, that's not really startup money. Startup money is your friends, your family, your fools, your business angels, those sorts of people, bit of grant money. Venture capital is about high growth. Let's take a big British brand and make it a big international brand.
Wow.
Right?
Yeah.
And to get from the point you have an idea and you write it down on a pitch deck to getting to the point where somebody will trust you to be, a future Elon Musk, that's quite tough. It's hard for a person to steer through all of those stages of a journey. Usually you see a transition of leadership.
And have you helped people achieve that venture capitalist?
Yeah. We've got one on the books. That's, like everybody else that's invested in things, there's always one outlier, right? That's gone really well. And seeing people go on that journey, going back to the mental health thing, it is not uncommon to see nervous breakdowns, to see all of the things that creep in when people are stressed. So their physical health gets affected. Sometimes bad habits creep in. So all of those things are things that you need to inure yourself against. It's like being an athlete. You're going on a marathon run, so you need to get fit, right? There you go.
Yeah, it's really interesting. I mean, some of the stuff that I've had where I've seen businesses where I think have a lot of potential and I've approached them. It's a bit like, I always compare it to like the UFC. I had a young cousin who's done jiu-jitsu and mixed martial arts all his life. And when he reached the age of 18, the amount of emails he was receiving from the UFC coaches, like, we can make you the next big star. They saw potential in him. So some of the times I would look at these businesses and go, I see potential in this. But one, for instance, was something in the car industry. And I thought, this is really good. And I approached the guy and I said, look, I'm prepared to come in as an investor with you. I think it's great. And in the back of my mind, I'm going, yep, he's good, entrepreneurial. He's got his head screwed on. This could be really good. And then when I spoke to him, I said, just make sure it's the right thing for you, and you and the family and what you want to achieve in life. He came back the next day and he said, I had to think about what you said. And I don't want an investor. I don't want the pressure. I don't want the accountability. I'm happy just being me as a car guy cleaning cars. And that's okay. But without asking that question, what is it that you really want for life? Have a think about it. He was going down the wrong journey until someone just pointed in to say, look, maybe you don't need an investor.
Absolutely that. Investors are partners in your business, and they can have a very different idea about where you're going to you. They can be very judgmental about you and what you're doing with your business, about you and what you're doing with your life, right? Taking on a partner that is, an independent brain that's having those thoughts can be an awful lot of stress. And if you're raising from angels, if you're trying to raise £250,000, that's 10 angels. So that's 10 judgmental souls that all of a sudden are there. If your business is starting to fail, you have in the back of your mind, I'm going to have to go and talk to those people and say, I've lost your money. And you should feel bad about that. So it's not something to go into lightly. If you then take money from a fund, they are pushing very high growth very fast. So they're going to put their foot firmly on an accelerator. And that means them coming in and saying, you're not hiring the right people. You're not selling hard enough. You're not going into the markets we want you to go in. So you get loss of control, right? You have to be happy with the fact that you're going to tie yourself to that journey, that rocket. I think that a lot of people romanticize what that's going to be like and don't realize what the actual feeling of that is going to be.
Yeah. Yeah. Well, they haven't been there. It's like the Dunning-Kruger effect, isn't it? I think it's all going to be extremely simple. And then next thing you know, here's the reality check.
Yeah.
Yeah. And that's probably where what you meant about having the qualification, right?
Just the personal.
Have you got
It
this?
is two sides. It's being a startup founder, in inverted commas, having that personal bent towards that life, and
Mhm.
also the qualification in your market. So there is two things that make up the qualification of a founder.
Mm-hmm. It's really interesting. So what about like people that aren't looking for the big next idea and they want to pitch their idea? What about people that have businesses, that are 2 years, 5 years, 10 years in, and I find, Joff, that a lot of times people go into business for like 20 years, but it's actually 1 year times 20. They just keep doing the same year over and over again.
Yep.
And they grow nice and steady, but they don't know that there's people like you out there that could help them achieve their dreams faster. So this is past that stage now where it was just a dream. It's now got proof of concept. It's trading. It could be a million plus business. What sort of advice would you give to business owners that are looking to scale?
That's a really interesting question. I think any business can move into a high growth mode if there is a market for them to go after, right?
Mhm.
And actually having a firm base to jump from is a really good place to be. So we've got a sustainable business model, but we've just noticed that actually with the application of a new technology, or because a regulation has changed, or because a supplier has come into our market that's opened up an opportunity for us, we can innovate and we can double, quadruple, whatever the size of our business. I think that you made a really good point, which is businesses tend to get on a set of rails and stay there, right? You go and you see fourth generation businesses that are still rocking the relationship that great granddad formed 100 years ago, right?
Yeah.
Any business can move into a high growth mode. I think those business owners need to make themselves aware of the architecture of high growth: incubation, acceleration, venture capital, private equity. We haven't talked about private equity.
So what's the difference between that then for the viewers? What's private equity compared to the others?
So, I mean, private equity is effectively private investors buying equity, for want of a better description. But private equity tends to have a flavor of venture debt, more commercial financial model. So venture capital is, we're going to put money into your business to buy shares, and you can use that as you wish. Private equity tends to be a little bit more like, we're going to structure a big debt line for you, which you can use to leverage up growth, or very, very focused on acquisition. Private equity tends to love a roll up. So we can see that in this market, if we have this business and buy up all the businesses underneath it, we can take a big market space.
Right.
So it's a little bit more debt focused. It's a little bit more structuring focused than venture capital, which is more like putting, hey, upper thumbs just appeared on my screen. I do like private equity business.
That's not on TikTok, by the way.
That's not a judgment. Venture capital is more like a shot of nitrous oxide into an engine, right? So slightly different financial tools for slightly different purposes.
Yeah, that's interesting though, because a lot of people don't understand this terminology. For you and I, it's just like, what we do with this, and it's big terms. It's like when you speak to the bank, and you speak to a bank, and then you speak to an accountant. They speak bank language, they speak accountant language, and as entrepreneurs in the middle, we're just going, yeah, I'll sign here then, shall I? It's good to understand this terminology by getting around mentors like yourself and having this different people giving you different education about business in different. I mean, the world at the moment is to the marketers, isn't it? The marketers right now are winning. Everything seems to be about growing a business is about your marketing, sales, marketing, go a higher level, because they're good at marketing. They're good at getting in front of you. But what about the people about the real business world that it's just isn't exposed enough, I feel?
No, and you're not helped by the fact either that there's a lot of grey areas between financial instruments and organizations. There are incubators and accelerators that provide space and education and support that also might provide a bit of capital. There is venture capital firms that also blend into private equity and vice versa. So, it doesn't help that sometimes there's no clear edges between things.
Okay, I'm going to go through a bit of a quick fire round now then, Joff.
Okay, I'll try my best.
Some quick answers.
Do we get a score?
You do. At the end, you'll be rated on TikTok, so we are live. So yeah. Okay, so how much equity to give would you expect from a company? How much equity would a business owner give to an investor?
Only ever raise the money that you need. That's a huge thing. You know, certainly at the earliest stages, founders tend to think in terms of, well, I'm going to try and get the most I possibly can. That is a silly thing to do.
Right.
You know, when you're getting up to later stages of investment, you can end up owning very little of your company. I would say most founders recognize a cap of about 20% in any given round, right?
Mm-hmm.
And that doesn't mean if you go through 5 rounds, you own nothing, because the way that you can think of giving away equity is it's like a pie. You're putting a new slice into that pie every time.
You're introducing more shares into the business, aren't you?
Correct. Yeah. So when we talk about being watered down, you know, that's the size of the amount of equity growing. So the bit that you own is getting smaller in relation to that.
But the reason for doing it in the first place, though, is to get the pie bigger.
Yes.
So it's a smaller part of the pie, but a bigger pie.
Correct. Right. and that's when money that you're bringing into your business is working well for you. Yeah. Every time you're bringing money in, it's causing growth, right, and substantial growth. When you are bringing money in to survive, that's when it's not working well for you. Right? Mm-hmm. So most founders, the answer would be don't give up more than 20% in any given round of investment, but the less you can give up, the better.
Okay, next question. How to prepare for investor meetings? What should a founder know cold before they sit in front of you?
So raising money from investors where you're giving up equity in your business, so not going to the bank, let's ignore that right now. Mm-hmm. It's just filling out an application form. But raising money from investors is not a transactional matter. You don't turn up with a pitch deck and they say, I love that, here's a check. Right?
Like Dragon's Den and Shark Tank are teaching us, right?
Right? That's not how it works. Typically, what you're doing is building a relationship over time, right? So a better version of that story is, I think we're going on a high growth journey. We are a fintech, and the fintech funds are Fund A, Fund B, Fund C. We're going to go out and talk to those investors and build a relationship so that when we're ready to raise, they know us, they know our story, they know our journey, and they will step in at the right time. So in preparation, it's getting to know the people in your market, that are the movers, that are the shakers, that are the investors, talking to them and understanding what they require when they invest and what stage they invest at. And those relationships then bear fruit later. Okay. So it's very different to that transactional attitude that, as you say, Dragon's Den puts people in.
Again, we've been fed the wrong education, haven't we? I mean, you never get taught this in schools. You never get taught it really in universities. No. Regardless of the MBA or thing, unless people like you and I come in and talk to them about it.
Yep. And I would say, ignoring us, who are an institutional, very early stage investor, but ignoring what we do, for most people, the first equity investment they're going to receive is from people that they know that earn more than £100,000 a year, mm-hmm. that care about innovation and like them as a person. There's another thumb appeared, I don't know why. And the reason for that is that they understand they're getting a tax break, you know, from what is the Seed Enterprise Investment Scheme or the Enterprise Investment Scheme, SEIS and EIS. They're getting a tax break on that investment, so it's more exciting than putting the money in an ISA or in their SIP, right? And that tells you that thing of most businesses getting their first investment from people they know. That's actually a very real version of how investment works. So they think that they're going to go and talk to some business angel group and stand up and present, and then a big check's going to arrive. But the reality is they probably already know their first 100 grand's worth of investors.
Well, yeah. Okay. So networking with investors and building relationships as opposed to, hi, Mr. or Mrs. Investor, this is my business idea. Give me money in the next week.
Yep. Better advice would be go tap up your rich friends, right?
Great stuff. Startup funding mistakes. What mistake have you seen founders repeat across different stages of business?
Lying. Huge trust eroder. That thing of fake it till you make it, that's really, really, really bad advice. particularly with investors. You need to be absolutely transparent about everything, lay it out on the table and say, if it's wrong for you, fine, right?
Yeah. Yeah.
So that's a big one. And not being prepared, right? I mean, now CEO of one of our businesses just joined us. He's been through a very big investment journey. And he openly says that they failed in a couple of rounds just because they didn't have the paperwork straight. You have the sense of what's known as a deal room or a data room, which is all of your accounts, all of your certificates, all of your insurances, everything kept in a neat and communicable way. If you don't have that ready, it's a great thing for running a business, by the way. You should have it anyway. You should have everything all filed away neatly. But if you don't have that ready, it's really hard to get through due diligence in sort of the seed and Series A and Series B investment rounds, because you look like you're a mess, right? So that's the other big mistake we see people making. They just don't have their ducks in line when the investors turn up.
And it's not good, is it, causing red flags in the first time that you start to meet with this? So lying, know your numbers. I always think that objectivity is better than subjectivity around it.
Yep. And I think I keep saying to people, get good at telling your story, but that's the very beginning of that opens the door. Then once that door's open, you're going to get asked some really far-reaching. You've got to pull up your skirts and let people have a look, and that means that you've got to have all of the details to answer the questions that come afterwards. That's what due diligence is. It's a lot easier at the beginning stages because angels expect businesses to be a bit loose. They're ideas that are just forming, but certainly as you start to get into bigger checks, it's fundamentals.
Okay. So how to use investment money? What should investment be used for, and what should it never be used to cover up?
Crisps, beer, no. The typical makeup of a first round is 60% product development, 30% go-to-market, and 10% administration, legals, those sorts of things. I always say to people, when you're putting your first pitch deck together, if that's the way the pie chart looks for the ask, everybody's going to go, that makes sense. Right?
That's right, yeah. Why is that then? Because it's logical.
Yeah. Investors are looking to, if you think about it in macro terms, they want to pay for the machinery that makes money. That's an asset, right? What they don't want to pay for is expenses that just frivolously let that money drift away, right?
Yeah.
When you're asking for money to pay for growth marketing, we need to be able to see that every time you pull a handle and spend $100, $300 falls out, $500 or $1,000 falls out. So that needs to be a machine that you can evidence works. If you're saying, oh, we need money for market investigation, we don't really know how to sell this yet, your investor isn't going to really like that because they are gambling on an unproven machine, right? What investment is not for is covering losses. Right? So if the business is just losing money hand over fist and doesn't know how to make money, that is really not where you should be expending the money that you're raising.
Wow. What about people? I get a lot of pitch decks as well that say, well, how money is going to be used to hire a sales director, a sales manager, a sales bit. And I'm going, yeah, but how many businesses have I got? So I'm starting my 12th business, just started this week. And the businesses that have been going a while have just got to this sales director place, and they've got these people in place, operations as directors, like the C-suite sort of team, the SLT. And the journey of getting there has took some lessons, because to get to the sales director we have currently, it's took us about 5 different sales directors of people that have just blown smoke. Yeah, well, so the next one. But you know what I mean? So buying and purchasing, using the investment to pay for human resource, it's not really an asset, is it? Because it's down to a variable of someone's ability to not just bullshit their way through an interview, but actually deliver.
It's a stage thing. So as you scale, you have to bring in a decent team. And you need the right experience around the table. Look at some of the biggest businesses so I come from financial services. If I was to look at the Mondo/Monzo journey, to begin with, they were technologists, ideas, founders, people that were innovators. But there was a point in time where that business was going to become a bank, and you needed to have a C-suite around the table with experience of running risk departments, running bank marketing departments. investments, right? So there is a point when you start to scale where you have to have the right people around the table. I absolutely recognize, by the way, that finding those right people is one of the biggest risks in a scaling journey.
Yeah.
You know, and particularly in sales, you know, good salespeople are like rocking horse shit. They're really hard to find. And bad salespeople ruin businesses, absolutely ruin businesses. But there is definitely a stage thing. If you're a startup, unless you can prove that bringing a person into your team is going to materially change your growth, and that's a very well evidenced assumption, then fine. But just paying salaries because you want to have a lot of people around you and you want to feel like a business, that's one of the big mistakes we see. You know, it's a common thread that seed checks get written. All of a sudden, the founder tries to build what feels like a business. So they put a lot of people in the room that look at them and say, aren't you great? And then they run out of cash really quickly. It's a really well-trodden story. I always tell founders at the earliest stage, so people pitching for angel checks, that angels won't pay their salary. Now, that's not entirely true. We don't want them to starve to death, give up and go and get a job. But it's better to tell them that than to give them the false estimation that the easiest way for them to survive is to get cash from an investor. The easiest way for them to survive is to go sell something, right?
Cash flow, yeah.
So
I always say that to a lot of people as well. Why do you want my money when you can just, have you ever thought about actually cash flowing it yourself?
Go sell it.
Why would you take an investor on and give away shares in your business when you could just do another smaller business to generate the cash flow to then start the bigger one that you have?
Side hustle, whatever. I definitely, so I would always advise, your salary comes from sales, your salary comes from profit, growth money comes from investors, right? And it's a better piece of advice than the saying, oh well, you know, because it's the wrong story. It sets the wrong expectation.
So what's life like after an investor get involved then? How does things change for them a personal shift? Does a founder need to make, what sort of shifts do they need to make personally to make sure that they are satisfying the investor and carrying on?
There's different kinds of investors, right? So there are those angels that want to be a bit involved in the business on a consultative level, and that's good if it's the right person, bad if it's somebody that's got into angel investment because they miss having a job. So we've not talked about, actually, angel investors sort of have some problems too, right? So there are people that are angel investing for the wrong reason. They sold their business, they miss being a business owner, they think this is a way for them to get back into business. It's not, it's an investment product.
Right.
But there are those angels that act like quasi-neds, quasi-consultants. They're there to help you. They open markets for you. And if that relationship is good, that's great. At very least, most angels would expect to be kept broadly up to date with how their investment is doing. Don't make that a weekly update. That's annoying. Monthly updates, you realize businesses don't change enough to really fulfill a monthly update. So after a little while, most people move to a kind of quarterly. It's like the letter that you get from your family, right? Every Christmas, like, these things have happened this quarter. Here's what was good. Here's what's bad. Here's the help we need. That's a nice cadence, I think, during the startup phase. If things are ramping quickly, obviously that becomes a little bit more frenetic. So, you know, at very least, keep your investors updated. Try to maintain a good relationship with them. The best kind of investors, as far as I'm concerned, tend to be people that have put their money into the business at that early stage. Talking about angels now, put their money into the business at that early stage. They care. They're there to help if you reach out to them. But for the most part, they're going to let you get on with running your own thing. If you can find them, great.
That's awesome advice. I mean, it's a bit like, you know, regards to the Dragon's Den thing. How do you tame your dragon? When do you know, by the way, this is a bit of the dark side of angel investing that you could share some insight on. How do you know when the investor is taking the piss?
Okay, yeah. So 3 things really quickly. Most people that you meet that say they're angel investors are not. They're trying to sell you something.
Interesting.
If you go to a pitch day and you look around the room, most of the people in that room are not investors. Most angel investors, the average angel investor in the UK, if you look at the UK, if you look at British Business Bank's reports or UK BAA, Most angel investors don't invest multiple times. They invest once or twice. So that tells you that angel investing isn't really a professional thing.
Yeah.
It's something that somebody does because they like that startup and they do it that one time, right? So that's why I say they're more likely to be friends, family, fools than they are professional angel investors. So when you go into that room, you need to qualify them in a few ways. Like, who was your last investment, right? Can I meet them? Right? That immediately gets rid of all the chances. How much are you looking to invest? You know, and do you understand the risks involved in it? Do you understand SEIS? Do you understand EIS? You know, what kind of relationship do you want to have with us as we grow? What are you hoping that this brings you? You need to immediately kind of get people to be open and transparent with you. Yeah, so, you know, people talk about doing 65, 150, whatever it is, pitch meetings. A lot of that is because they're just not qualifying the people they're pitching to. They haven't understood that the person that they were selling their idea to was never going to give them money in the first place.
That's quite interesting. I mean, there was a guy that we was looking at. He does AI in construction in Dubai. So that sounds sexy, doesn't it? AI construction property in Dubai. It's like, that's 3 big bells. And then I saw him on LinkedIn. He's a nice guy, and he said that after 200 pitches to investors, one of them finally said yes. But I think the idea, what you've just said there, is that probably like 195 of them were never really going to invest in the first place, mate.
Yep. Yeah. And that's quite usual, right? The other thing I think, you know, when I've seen people do this well, they treat those investor conversations a bit like talking to customers. They take insight from them. They take, you know, they understand the investors' frustrations, the things that they wanted from them. One of our founders has a spreadsheet with all of the meetings that he had, what pitch deck he used, you know, version 1.1, 1.3, so on and so forth, and what the people said to him in that meeting, what output. So he asked for feedback, he took the feedback, he codified the feedback, he fed it into the next version of his deck, right? One of the really interesting things about that spreadsheet is you could see investors coming into later rounds. He went back to people that were earlier in the spreadsheet that said, we're a later stage investor and we look for this. So he didn't just see it as a no. He went, right, when I get to that stage, I'll go back and knock their door.
Yeah.
So he was building up all those relationships. He was listening to what he was being told. And then he used that information both to improve his pitch, but also to go back and have more meetings with them at the right time. That's why he's very successful in his kind of fundraising strategy. Not many people do that. They hear the no and they go, oh, my idea was bad, and they give up, right? That's completely the wrong way to take those meetings. So qualify the people you're speaking to. Unqualified investors, their feedback to you doesn't matter. They're saying something so they can feel smart about themselves. Ignore them. Qualified investors, take their feedback, use it, listen to it, iterate upon it, get better at your job of raising money.
That's interesting. What golden nuggets there of advice. So we've got a question on TikTok before we finish, and this is a real life example for you then, Joff, just to see what your thoughts are. A guy on there, Tito, LionSec Hub is a high yield cybersecurity firm and elite engineering foundry. We protect the continent's fastest growing, which is in South Africa, by the way, fastest growing fintechs and enterprises through active threat defense. Beyond capital, so here's the question. Beyond capital, how can your fund plug us directly into your fintechs and enterprise portfolio? So he's asking here then, other than funding, what else do people get if they have you on as an investor?
That's a really good question, which I'm going to broaden out a bit rather than just talking about me, because I've not got an ego that big. You know, there is this thing of founders hoping that their investors are going to do an awful lot to kind of develop their business, to be business development partners. And the experience for founders is really poor if that's their expectation. Why is it really poor? If you take let's take a fund that's raised £20 million, right? So I'm a £20 million early stage fund. Not unusual in the UK. So, You know, 20 is sort of a starting ticket for a seed stage fund. Someone like Fuel probably started there. Future Planet Capital's regional fund here in the West Midlands, where we are, is about that size. The traditional kind of revenue model for a fund is 2 and 20. So they're going to be taking 2% management out of that every year to pay their costs. That's £400,000. Right? So that pays for one fund manager, a few events, and a couple of young kids that are going out and finding deal flow for them, and not much else. So it doesn't really give them, and by the way, what that fund manager's job is to find the next 20 million, really. So they look up, they're looking for the next chunk of money because that's how they survive.
Yeah.
So they don't have much time as a professional to go out and help you find your next deal, to help you. They'll do their best. They'll provide some mentorship. They might have some connections in their Rolodex, but they are not there as a marketing and sales engine for you. Nor are they there for, you know, they might plug you into their, if they're a bigger fund, they might have a legal person on their council that can help you and those sorts of things. But really, they struggle to do much more than that because they don't have the money to do much more than that. So set your expectations a bit lower, right? Your investors are going to provide you with capital. They'll help you as much as they can. But in terms of selling, in terms of going out into the fintech market, sales cycles are long. You need to have an evidence base that says we can do this better than everybody else. You're going to have to get good at dealing with the fact that most procurers don't like startups because they're too small to deal with their massive customer base. So if you're selling to a bank, I was with the CEO of a tier 1 bank a couple of weeks ago. And as he said, you know, if I've got 17 million customers in this portfolio and I plug them into your service and you've got 2 staff, what happens when something goes wrong, right? So best way to sell into those groups is to get into innovation acceleration programs within banks and within building societies within the country you're in, building up the relationships, starting off with joint ventures, starting off with smaller relationships and building credibility in your market. It's the only way it works.
Amazing advice. There you go. Just save somebody 10 years of their life. That's what we're on this podcast for. Joff, really appreciate today for coming on the show and sharing your knowledge and your wisdom. And I think there's a lot of information here that is, again, going to save entrepreneurs 10 years of their life. So thank you for coming on.
No problem at all. It's good fun to do these things. It's lovely to see you, Lewis.